The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled Captive Insurance Companies Get a Win. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you very much, Amber. Welcome, everybody. I'm glad you joined us here for today's topic, Captive Insurance Companies Get a Win. It's an exciting time in our business. There's a lot going on, but you know, this particular win for captive insurance companies shouldn't be overlooked, and I'm glad to talk to you about it today. Before we get into the meat of today's presentation, let's decide on what it is that we're going to cover next month in December. Remember that these free webinars are held on the first Wednesday of every month, and there's no exception here. The next month's webinar will be on Wednesday, December 1st. Your choices are estate planning for real people, the case for making large gifts now, and HSAs in a nutshell. I'm going to go ahead and open the poll and ask you to vote for what it is that you'd like to hear about next month. So please go ahead and cast your vote. I'll give you a few seconds for that. If you haven't voted yet, please go ahead and do that. I'll give you a couple more seconds. All right, we'll close the poll. Looks like everyone has voted. And next month's topic will be estate planning for real people. Thank you for voting for that. And let's go ahead and get into the content for today. So captive insurance companies have made the rounds in our business. And if you've been in attendance in some of our webinars in the past, you know that we've talked about some of the issues with regard to captives. The biggest issue in our business is that captive insurance company arrangements have been under IRS scrutiny, and the service has really put them squarely in their crosshairs, listing them on their list of dirty dozen tax scams back in 2014, at least some of them, the ones that they consider to be abusive. In 2016, the IRS put out a notice, and it identified certain kinds of micro captives as having the potential for tax avoidance and tax evasion. And in the notice, it required participants in them to report them as listed transaction to the service. The IRS has also had an unbroken winning streak in court cases that it's fought against captive insurance arrangements. And that's been true until now with the case that we're going to talk about today. Before we get into the win, let's talk about the recent court cases that are losses for captive insurance companies. We've got the Salty Brine case from 2014, in which the Court of Appeals for the Fifth Circuit upheld the federal district court's decisions that disallowed the deductions for premiums paid to a captive. Court ruled that in the case at hand, the premiums were not necessary, nor were they ordinary business expenses. In the Avrahami case from 2017, the court again concluded that the setup wasn't really a valid insurance arrangements, and thus the premiums were not going to be tax deductible. In the Syzygy insurance case, there's a pattern here. The court decided that Syzygy didn't have a valid captive insurance arrangement in place, and therefore the premiums were not tax deductible. And in a case that we talked about earlier this year in the webinar, the Kaler land development case, the court said that, again, the insurance company did not provide insurance, and therefore the premiums that were paid to it by the operating company were not tax deductible. Now, why do we even bother talking about these cases? Well, I think in order to understand, why the decisions about captive insurance companies are important, I think it's important to have at least a little bit of a knowledge about how captives work. And so I'm going to review that in a very simplified way. The first step in the captive process is that a successful business owner, somebody that has a profitable operating company, creates a captive that insures certain kinds of risks in that operating company. And arguably, these are the risks for which commercial insurance is either way too expensive or is not available. And so in order to cover those risks, the operating company creates its own insurance company, a captive insurance company. And the operating company pays premiums for those extra risks that are insured by its own captive company, pays premiums that are at least arguably related to the risks that the captive is insuring. And once the captive receives those premiums, it pays whatever operating expenses are associated with the captive, but most of the premium, instead of being taxable profit, they go to reserves. They are reserves for future claims, and so the captive insurance company doesn't have to recognize those premiums that it receives as income in the year that they're received. And so the operating company gets a tax deduction for the premiums paid to the captive, gets at least arguably 100% tax deduction for the premiums that it pays to the captive, but the captive doesn't recognize those premiums as income in the same year. And so there you go. That's the reason why captive insurance companies have been relatively popular. Now, why are they popular? What are the problems? How has the IRS attacked these? Well, the big issue is that there are promoters out there that are selling captive packages, and the promoters persuade the owners of a successful, closely held business to participate in the captive arrangements, but at the end of the day, those arrangements fall down because they don't act like real insurance. And that's how the courts have successfully, or the IRS has successfully attacked captive arrangements in court. Here are some examples of how the implementations failed. First of all, the coverage don't really match actual business needs, right? Coverage might insure business against the possibility that an asteroid is going to fall on the business and shut it down. Well, that's an example of something that might not be considered to be an actual business need, an actual business coverage. The premium amounts are a lot of times geared to a desired tax deduction by the operating company rather than an actuarial calculation of a reasonable premium connected to the risk that's being insured. And so that's another way that captives fail to meet the requirements. And then, the administration of the actual captive policies may not match the liabilities of underlying operating companies. What am I talking about there? Well, sometimes the operating company may have a situation where it could lay a claim against the captive, but it decides not to, right? Because it wants to keep more money in the captive. And so, all of those things are examples of a captive insurance arrangement falling on its face, and there are reasons why the courts have failed to honor the claimed tax deduction for the premiums the operating company pays to the captives. So, why is this a big deal for those of us in the life insurance business? And the answer is that, the captive implementation here concludes with premiums that are received by the captive company becoming reserves for future claims. Well, the reserves have to be parked into something, and a place that promoters have suggested that those reserves be parked in is in a permanent life insurance policy. And so the captive ends up being the conduit through which permanent life insurance is purchased, and the permanent life policy that's inside the captive may have various other objectives that the business owner is trying to achieve, and so the permanent life policy can do double or triple duty when it's parked inside the company. And of course, this ends up being the holy grail of life insurance because, in a way, the premiums that are paid through the operating company to the captive are tax deductible to the operating company. The premiums are not included in the personal income of the owner of the company, nor are they included in the income of the captive. And so, in a way, this is the answer to the question that we get asked at Advanced Underwriting Consultants almost every day, which is, how can I pay for life insurance on a tax deductible basis without having to include the premium in my personal income? So captives have kind of been packaged that way in our business as a way to achieve that result. So the case we're going to talk about today is CIC Services, which ended up being a Supreme Court case. Let's talk a little bit about how it ended up being a Supreme Court case. So CIC Services filed suit in federal court disputing the IRS's right to enforce Notice 2016-66. Remember, this is the notice in which the IRS defines certain kinds of captive implementations as listed transactions that must be reported to the IRS. And in its complaint, CIC Services said that, well, the IRS failed to go through proper administrative procedures in issuing Notice 2016-66. Therefore, the notice cannot be or should not be allowed to be enforced. Well, the district court said, well, IRS, we agree with you that this case ought to be dismissed. CIC Services appealed the case, and the appellate court affirmed the decision of the district court. What is it that the appeal was based on? Well, the appeal was based on CIC's argument that the notice should be set aside, that the IRS failed to go through proper procedures. And the government, the IRS, and the government asserted that the law says that you can't prevent the service from trying to enforce or collect a tax. And here, there's a penalty associated with the failure to comply with the notice, which is in effect, the IRS said, a tax. And both the lower court and the appellate court agreed with the IRS that that the provision that says you can't file a suit to prevent the IRS from collecting a tax would require a dismissal of this particular lawsuit. Well, CIC Services appealed to the Supremes, and the Supremes, of course, agreed to hear the case, which is why we're talking about it today, U.S. Supreme Court. So that's the deal. We're talking about IRS Notice 2016-66, and the question is was the IRS required to go through proper publication and notice and comment procedures to publish the notice, which it didn't do. And Justice Kagan wrote the opinion of the Supreme Court, which was published earlier this year in May. And, Justice Kagan pointed out or summarized how captive insurance and the listed transaction process is supposed to work. Justice Kagan, explained that captive insurance companies get a deduction for the operating company. The insurance captive can exclude a fair amount of those premiums from taxable income because of reserves. And Justice Kagan conceded that the IRS its job is to police those situations where abusive tax situations are taken advantage of by taxpayers. And so Justice Kagan, gave the history and noted that the IRS issued notice 2016-66 and put certain kinds of captive insurance arrangements as listed transactions. And Justice Kagan also summarized that the Anti-Injunction Act says that no suit can be filed for the purpose of restraining the assessment or collection of any tax, which is the argument that the IRS used in the lower courts. It's the provision the IRS relied on in the lower courts, saying that it didn't need to do any kind of seeking comment when it implemented Notice 2016-66. But what ended up happening is that Justice Kagan, writing for the court, said that not so fast. The suit really targeted the notices reporting rule, not its penalty rule, and that Justice Kagan agreed that the Anti-Injunction Act doesn't really bar CIC from challenging the notice because it was only aimed at the reporting requirement. It wasn't aimed at the service's ability to collect penalties if the reporting rule wasn't followed. And so Justice Kagan said that the Anti-Injunction Act imposed no bar, in that Justice Kagan disagreed with the lower courts, and all of the other justices on the Supreme Court agreed as well. And so in a unanimous decision, the US Supreme Court said that CIC Services case should in fact be heard by the lower court. The case was returned to the district court for a full decision on the merits, and we're not exactly sure how that's going to play out, although it seems clear that the IRS will not be able to enforce the provisions of the notice unless it goes back to the drawing board and does something different. We'll see how that plays out over time. And so for those who are advocates for captive insurance companies, this is certainly good news. So what are the conclusions that we ought to take away from this case? Well, first of all, micro captives are still tempting. They promise, when bundled together with permanent life insurance to provide the reserves for the captive, that life insurance is paid for with pre-tax money. With so many other ideas that have been effectively shut down in recent years by the IRS, it makes sense that captives have gotten more attention and that this case would be seen as good news. Now, even in light of this case, captive implementation, it's still not risk-free. They can still be attacked. Captives can still fail to be legitimate business arrangements, and deductions claimed by companies implementing captives can still be denied. It's just that this case said that the notice, which put certain kinds of captives in the list of listed transactions, that has essentially got to stop unless the IRS does something different. And so I think going forward, a lot of people are going to give another look to captives, but there's still risk, there's still a high cost of implementation. And so it's not a panacea. It's certainly not undisputed great news, and everyone's now free to implement captives, but I think it'll encourage people to give captives another look. And so at this point in the presentation, I'll just close it up and I'll ask Amber to bring us home. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, you're welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month. That will be December the 1st at the same time. Next month's webinar will be titled Estate Planning for Real People. You can find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again and best wishes for continued success.